Hello, hello. Coming to you live and well, Patrick Prunty here from sunny Southern California. I will be your host tonight for Non-Recourse Financing by Marshall Reddick. So one thing I can tell you guys, it is a great time to be a real estate investor. But I mean, certainly we're in, due to coronavirus or COVID-19 or whatever you want to call it, we're in a foreign environment, if you will. None of us know kind of what the short and long-term effects, economic effects are going to be. However, I can imagine the same as myself and those on the call that out of this environment, we should expect some super buying opportunities. Expect and be prepared, more importantly, for some of those opportunities. As I'm looking at the folks on the call tonight, certainly we have a fair amount of new clients joining us. However, I can see a lot from the old guard. And what I mean by that, I'm talking about 20 or 30-year Marshall Reddick clients, those who through Marshall Reddick over the past few decades have really benefited from what real estate investing can do for you and for your financial independence goals. So, it's my pleasure to be on here with you tonight, as usual, jam-packed presentation. And I'm so happy to be with you guys so you can take advantage of one of the best parts about Marshall Reddick, which is the free education. As we continue through tonight, I'm thinking back on the last few cyclical recessions that this company or this country has had. And it's those investors who were prepared. Some got lucky, but some were prepared. They were prepared with the knowledge, connections like those that we here at Marshall Reddick offer, and also the cash or the financing ability to be able to put fear aside and benefit financially at unprecedented levels. So again, I just want everyone to know that we have some super buying opportunities coming up. And to be prepared. A little bit about Marshall Reddick. We've been in business a long time, right, since 1979. And we help in a number of different capacities. One of those obviously is brokerage. And I want to speak a little bit about that in terms of what resources you have available here. So whether you're owner-occupied or you're buying investment property, take advantage, right? And Tanya Lorimore is one of those advantages. She's your real estate advisor, right? So she will be following up with all of you on this call tonight. She is your conduit to buying rental property or in fact, a primary residence here in California, but in any of our out-of-state markets as well. So take advantage, right? Tanya is someone like myself who's been with Marshall Reddick a very long time, and someone who has the professionalism and the experience necessary to kind of help you and be that conduit to those real estate transactions that you need. So make sure that you reach out to her, and I just encourage you to schedule a consultation. It's complimentary, so it's free. I mean, why would you not take advantage of this type of opportunity? Right, she's going to be able to get you in touch with all of the players in the game and all of those people who can really help you as you build your team. So back on what Marshall Reddick does, property management, that's another big thing, right? So you're going to, whenever you buy, at least on the investment property side, you're going to need someone to manage your baby, right? And so we specialize in single family, but also in small multifamily properties as well. Kind of a full service property management with some of the best rates in the game. And then kind of what we're talking about tonight specifically is the private financing. And a lot of people don't realize that Marshall Reddick offers direct private financing. And one of the cool things about it is a lot of the capital being lent on these private loans comes also from Marshall Reddick clients, which is kind of crazy, right? So we've utilized technology or leveraged technology and kind of created a multiple listing service for loans. And that's not really a topic for tonight. We want to dive into kind of the rates and terms and the programs that we offer on the borrow side. So again, as this unknown economic time unfolds, you can always count on Marshall Reddick to be able to provide financing, in some cases at low leverage amounts, and in some cases at very high leverage amounts for whatever different type of real estate investment you're looking at, because that's obviously one of the best parts about real estate is the ability to use leverage as opposed to being able to pay cash. Also important to know kind of our geography. A lot of people don't realize that we've got a national footprint. So on the screen, I've got our offices, right? So our corporate office in Newport Beach, where I am based out of, and our lending team is based out of. We also have an office in Los Angeles, a couple in San Antonio. And when I say our own offices, I mean we literally have a brick and mortar office. We've got our own W-2 property managers, our own licensed under the Marshall Reddick brokerage license in each of these states, right? We do property management in each of these states. And a lot of the benefit that we have is that you can, take advantage of like a one-stop shop, right? If you have property in California, you have property in Texas, you have property in these other markets, right? It's like you're dealing with one property manager, not multiple property managers all across the country. So that's a super benefit of having that one-stop shop. And I'm really proud of the one here on the bottom. Our most recent office is there in Florida in the Cape Coral office. So continuing of Marshall Reddick national domination. Moving along, when it comes to private financing, guys, remember that you always want to go conventional if you have the ability to do so. All right. Private financing is only for specific instances, because with conventional financing, right, you're going to get the lowest interest rate, the lowest down payments, the best terms. But you can't always qualify for conventional financing. And if anyone's done it lately, they know that it's a really difficult process. So remember, only go private when necessary. Some examples, right? When would private financing be necessary or helpful? Well, here's some of these that I hear all the time, right? I want to use my self-directed retirement account. I personally have a self-directed IRA LLC. I own rental property inside of it, and you need a special loan called a non-recourse loan to be able to do that, right? So you can't get a conventional loan when you want to buy inside a retirement account. Another option, I already have 10 conventional mortgages. I hear that all the time. Here at Marshall Reddick, we've got many, many thousands of investors building large rental property portfolios, and they get to a certain point where they can't qualify. Now, that has nothing to do with their FICO score. That has nothing to do with their cash in the bank. It's just a hard stop Fannie Mae guideline stating that a conventional lender cannot make a loan if it's a borrower's 11th, 12th, or so on conventional mortgage. In that case, you need to opt for a different avenue, which could be private financing. I have plenty of cash and excellent credit, but I'm self-employed or retired, right? That's absolutely right. When you go into retirement, obviously your income drops and you're not employed. And a lot of times that's a problem with the conventional lender, which everything that a conventional lender does is revolved around your FICO score, your credit profile, right? Your income and its debt to income ratio. With private financing, none of that is applicable, right? It's a collateral-based financing and underwriting. We're going to get into that. Same for self-employed, right? We get a lot of folks, and a lot more folks self-employed today than ever before. And we have options for those people. What about low loan amounts? Certainly, there's ability to buy rental property, not in California necessarily, but in some markets in Kentucky and Tennessee where we have offices, you could buy a very nice rental property for $75,000 or $80,000, and you may, have a ability to buy that with leverage, but you would need a loan amount under $50,000. Conventional lenders, there's not enough money in it for them. They don't make loans under that kind of $50,000 level. What about folks with LLCs or corporations, right? That's pretty popular. And you talk to a conventional lender about that and you find out, hey, unfortunately, I can't make a loan to an LLC. Well, that's not the case again with private financing. We actually prefer to lend to LLCs, corporations, or trusts, any other vehicle like that. What about I have little cash or poor credit? Unfortunately, no, that's not when private financing is needed or helpful, so we're going to scrap that. We'll talk a little bit more about that, but certainly the loans afforded by Marshall Reddick are not for the subprime. So kind of some topics of discussion for tonight. Certainly it's like, hooray, there is an option outside of the very stiff and rigid conventional lenders that are out there. And we're very proud to bring you that program here from Marshall Reddick, including non-recourse options, right? And this is becoming more and more popular for self-directed retirement accounts. So just know that Marshall Reddick has those options for those people who want to supercharge that retirement account and use leverage. Because otherwise, if you don't and you can't get a non-recourse loan or you don't know where to go get one, your only option for buying rental property inside of a self-directed retirement account is going to be paying cash for the property. And then you lose one of the main benefits of buying real estate again, which is leverage. Okay, so other important thing for you to know, non-owner occupied. Okay, so we're making business or investment purpose loans. These are not personal, family, or household loans, therefore non-owner occupied only. We also have options for purchase, refi, or cash out refi. There's some different loan to value levels, but know that all of these different options are available. It doesn't just have to be a purchase money loan. We'll talk a little bit more about the collateral-based approach, which again has nothing to do with employment, income, or FICO. We'll talk about some programs that we have available, and we'll also talk a little bit about the process. One I don't have on the screen is our frequently asked questions or some kind of some Q&A, but I am going to go over that as well. So let's talk non-recourse defined first off. So this is a secured loan. And the lender can always take the property in as collateral, right? The pledged property that's the collateral for the loan. But the difference is that after any foreclosure, wherein the lender has to take the property, they cannot pursue. The lender is that they cannot pursue the borrower for anything further. Right? And that's important. That's a legal requirement for self-directed retirement borrowers because those IRAs and pension plans and 401ks that you may be using to buy, those are federally protected. Okay. And so certainly if there's a default, the lender can foreclose and take the property, but any other assets of the IRA or 401k would be protected. And so the lender knows that going in. Right? And because of that, a lot of you who are unfamiliar with non-recourse loans will be shocked at how low the loan to value is, which again kind of goes back to what I said in the beginning. Only use private financing when conventional financing is not an option or when you have to. Let's talk loan to values. I mentioned that. So Marshall Reddick's programs for our purchase money, meaning you're buying a new rental property, we're going to 65% loan to value. And that's just a hair higher than most of the lenders in the country, like North American Savings Bank, for example. They're one of the largest and one of the only kind of institutional lenders that will make non-recourse loans. They're at 60%. You'll find that 60% loan to value is very common. So we're going up a hair higher for that for purchase money. We're going to stick with 60% LTV for rate and term refinance, which means just replacing the debt. We're not getting any cash out. As far as cash out refinance, no problem there. All right, which is kind of important, right? I have investors all the time who are buying distressed assets, fixing them up. And then once they're fixed up and they will appraise for a good value, they'd like to borrow against that now performing asset, that stabilized asset that's rented, in order to get some cash back to go and do that same process over again. But in this case with cash out, we're limiting the loan to value to a maximum of 50%. Okay, those are kind of some low LTVs. How come they're so low? Well, that kind of segues into the next kind of topic, which is our collateral-based approach to lending. So again, in these business investment purpose loans, these are literally no doc loans. which kind of has a negative connotation to it, but that's only because the no-doc loans were prevalent around the 2007, 2008, 2009 recession that we have. But those are a little bit different than what I mean here. What I mean is that we're not checking credit, right? We're not verifying income or employment. And we're not asking for loads and loads of documentation like you're going to get in a conventional standpoint. So we're not asking for a scheduled real estate own. We're not going to be looking at tax returns and the corresponding documentation. These items, from Marshall Reddick's perspective and my perspective as the director of private lending, these items are irrelevant in collateral-based lending. We are concerned with the asset, right? The value of the asset, the borrower's equity in that asset, the cash flow of that asset, and not about the borrower and what their FICO is and that type of thing. So it's a totally different, you got to put your hat on in a different capacity to kind of understand what I'm talking about. So what do we check on the other hand, and what is relevant in collateral-based lending? So certainly borrower cash for down payment and reserve. So we are going to be asking for bank statements. And if you're like an LLC borrower, a corporate borrower, certainly we're going to expect that you have a bank account set up for that. Kind of a red flag for us if you say, hey, I'm going to borrow my LLC and ask you for a bank statement. And you're like, oh, well, I don't have a bank account for that LLC or for that corporation, right? So you want to make sure you're doing things correctly and not commingling. But certainly cash is king when it comes to collateral-based lending. As far as the value goes, that's very important, and that kind of segues into borrower equity. So for our rental loans, we have an appraisal, right? That's a requirement, and we have an appraisal management company, just like a bank would, where it's a third-party appraisal. We just order it right online. The appraisal management company kind of facilitates all that, and we get a true third-party opinion of value. Also extremely important in the collateral-based approach is property cash flow and the debt service coverage ratio. That's what DSCR stands for. So kind of going back to my question on the prior slide there about the low loan to values, the private lender hedges the risk with low leverage and hence low maximum LTVs offered in Marshall Reddick's private lending programs. I mentioned cash flow and debt service, and I want to take that a step further, right? The property must stand on its own, right? It has to have an extremely high positive cash flow, and this is very important for those retirement account borrowers listening in who have maximum annual contributions. I mean, you just don't want to be in a rock and a hard spot where you've made your contributions and you're short on reserves. And the property was running a negative cash flow, would be eating the retirement account alive, and you just can't afford to do that with a non-recourse loan. So across the board, all of our loan programs are applicable for retirement account borrowers or non-retirement account borrowers, but we force extreme positive cash flow. And how we look at it is we go ahead and we do an independent analysis on market rent. It's one of the roles of my underwriting team. And they're going to basically deduct 25% of that current market rent. And then therefore your maximum allowable principal, interest, taxes, and insurance, your full-on outflow monthly payment, can be no more than 75% of market rent. I've got the asterisk there. HOA is part of that maximum outlay allowable. So those that are considering buying condos, private financing most likely won't work. It kind of kills that debt service coverage ratio. So an easy example here is if the underwriter indicates that market rent is $1,000 a month for this particular rental property, your maximum monthly payment could be no more than $750. Therefore, the borrower is running a $250 positive cash flow per month. And that will help offset maintenance costs, reserves, vacancy costs, things of that nature, which those that know us at Marshall Reddick understand that we know that those are real costs and they're very important when analyzing a rental property. With the debt service coverage ratio, B cognizant and careful of certain geographic locations. Some prime examples of that would be price to rent ratio problems. So Phoenix sometimes has this where the values are really high, but the rents maybe aren't in line with those values, right? So it's like if the property appraises for $200,000, when the loan amount then at say 60% loan to value would be $140,000. In that case, you better make sure that the market rent, and therefore 75% of that will support what your monthly payment is at a loan amount of $140,000. If it's not, we're still happy to make that loan, but we're going to have to drop the loan down below the maximum allowable loan to value to bring that monthly payment, again, principal, interest, taxes, insurance, and HOA if applicable, bring that monthly payment down to where it will qualify for the debt service coverage ratio. This is also the case in high property tax states. Take Texas, for example, or maybe high insurance cost states. Some areas of Florida that are coastal have higher than normal or higher than usual insurance costs. So just be cognizant of that, because there's basically two real qualifications to private financing. It boils down to, is the loan to value there? So is the equity there? And do you have the cash for that down payment or the equity position in the event of refinance? And then the debt service coverage ratio, wherein your monthly payment can be no more than 75% of market rent. When's private financing appropriate? We talked a little bit about this, but number one, when the conventional lender can't help you, right? We've talked a little bit about rental properties, and that would be our rental programs, but we do offer some short-term renovate programs. And by short-term, I mean literally super ultra short-term at a maximum of 12 months. And these would be when a conventional lender can't help you because maybe the property needs a boatload of work, right? It needs a lot of renovation. In that type of situation, you just can't get a conventional lender to do it regardless of your qualifying capabilities. So there's also, these again are not for subprime borrowers, but rather the investor sick of hearing the same thing we've heard, and the list goes on and on and on. I mean, I literally had horror stories of people calling me and they're down the road in the loan process, and they're intending to borrow inside of a self-directed retirement account, and the lender's like, huh, non-recourse? What is that? Right? That's when you know you're in trouble, and that's when you know you need to call a sophisticated and appropriate lender like Marshall Reddick. Additionally, one of the other items and points in time when private financing is appropriate is speed and customer service, and when those become more important than cost and interest rate, right? I don't know if anyone's gone through a bank or a conventional loan process recently. It's not the easiest process, and especially for those borrowers with a fairly sophisticated credit profile, a lot of properties, a lot of rental properties, maybe a lot of other investments. And I mean, the documentation request literally will drive you mad. And so the experience sometimes getting through it is just one you don't want to deal with. It's worth it for the 80% loan to value and 4 or 5% interest rate that you can get as compared to private financing. But do know that there are other options available. Use them when appropriate. As far as our programs go and our fee structure, we really strive to offer straightforward pricing and fees. So we wrap everything literally into the loan fee. We do also have a documentation preparation fee. That's a flat $275 per loan. And then loan servicing can sometimes be a cost borne by the borrower. I'll talk a little bit about that, whereas usually loan servicing is a cost borne and the responsibility of the lender. That's not always the case with our private financing programs. But getting back to the loan fee, that's going to be a percentage of the loan amount. It's very common. But what we're getting at here is that we avoid junk fees, right? And I mean, a lot of lenders, be careful. They will kind of lure you in with no points, right? Or 1 point or a low origination fee, a low loan fee. what they're not telling you is, hey, there's a $9.95 underwriting fee, a $6.95 processing fee, and a $2,000 administration fee. Credit check fees, application fees. I mean, I've literally heard all of them. So understand that we take a straightforward pricing approach to our loans. I'm going to dive a little bit now into kind of the specifics. On the screen now, you have our rate card for our rental property loans. Okay, so note that these are our long-term loans, and we've got some pretty competitive as far as non-recourse loans go. And that's really, Marshall Reddick got into the business to support our clients who are utilizing a a retirement account, and were asking us for, where can I get a non-recourse loan? And I said, why aren't we making non-recourse loans? And so with that in mind, we kind of created this program, right? So we've got 5 to 30-year options. And certainly the interest rates are higher, but they're in line with non-recourse options available overall in the general marketplace. Understand that in the matrix here at the top, the APRs, the payments quoted, these are based on a $100,000 loan amount, so you can easily kind of on the fly estimate what your monthly payment would be at these interest rates for varying loan amounts. And also understand that the 65% loan to value there in the far right column is only applicable to purchase money loans, and is going to be based on the purchase price or appraisal, whichever is lower. Again, very similar to a conventional lender. Be advised of the 3-year interest guarantee. This is kind of like a prepayment penalty, but what it is that going into the loan, you should plan to make the regularly scheduled monthly payment for 36 months or 3 years. And if you do that, you have paid the interest guarantee and therefore be able to pay off at any time without penalty. You're able to pay off the loan earlier, but let's say that you make the regular payment for 24 months, right? 2 years. Well, you end up with a shortage on that interest guarantee, which translates into an into a prepayment penalty, so that the lender earns the benefit of a full 3 years worth of interest based on the terms and the amortization schedule of the loan. Also keep in mind, I mentioned on one of the prior slides about loan servicing. So with our private loans, loan amounts at lower than $75,000 will have borrower paid loan servicing. So as a part of your monthly payment, you will have to include an additional $20 to offset and pay for the loan servicer's cost. For loan amounts $75,000 or greater, it sticks with the lender, and it's the lender's responsibility to absorb that $20 per month flat fee, regardless of the loan amount, from the payment they receive from the borrower. As far as these rental programs go, they're actually faster than most conventional lenders. I mean, a conventional loan process today with some of the big banks can literally take 45 days, maybe even 60 days if we're talking FHA, and it's a nightmare. So the 21 to 30 day close, it's really quick, and a lot of times that's going to be based on you as the borrower and you getting us the documentation necessary, or in the event of a retirement account, like dealing with that custodian, right? Because that custodian sometimes can be cumbersome if you have that, as opposed to like the checkbook IRA or the solo 401k. The appraisal, that has an interest in that. Certainly in our environment right today, we're having a delay in a lot of our appraisals. But what you won't be waiting for with our rental program is you won't be waiting for Marshall Reddick. Whereas I'm describing in a conventional lender situation, oftentimes you're waiting for them to just check off box after box after box in the process. We have very few boxes to check, and so this timeline is not going to be contingent on Marshall Reddick. We always require third-party loan servicing, right? So Marshall Reddick does not service the loans. Okay, so we use a couple of relationships, Superior Loan Servicing. They're based here in California, as well as Note Servicing Center. They don't all service all 50 states. Some service some than others, like Superior Loan Servicing. They service in Florida, so we use them for Florida loans, whereas Note Servicing Center doesn't, and a few other states. So, but those are our relationships. We don't have any affiliation with them. They're completely third party, but know that loan servicing is required. I'm going to talk a little bit more about loan servicing as we move along in the presentation, but just want you to know that it's definitely a requirement for our rental program loans. Now let's kind of talk and switch gears about our Renovate programs, right? And these are pretty cool, and you might consider these like for those bigger pockets folks. You've heard BRRRR. Think I got that right. This is basically where you want to kind of put in the sweat equity. You want to buy the property maybe in a distressed state and kind of do the legwork, right? Get it renovated, get it occupied, and all these different things in a situation maybe where a conventional lender wouldn't even consider lending against a property that needs work or that won't appraise and has like a future value or an after renovation value. So here's some common situations, right? I paid cash for the acquisition, and then people would do that to get, a great deal really quickly, but they need to borrow. Now they're out of cash and they need to borrow towards that renovation. That's certainly something that we, with private financing in our Renovate program, can help with. What about I need to close quickly on the acquisition, but I have cash to cover the renovation? Right? Certainly, we can close substantially faster in this Renovate program than any conventional lender, right? We're talking like 10 days. That's round trip from application through underwriting, docs, title insurance, you name it. What about this example, right? I have some cash, but I prefer to borrow for the acquisition and the renovation. That's absolutely possible, right? So we have Renovate programs that will allow you to both. But what our Renovate program will not do, it will not finance 100% of everything, right? So you must have some cash to participate, and we just want to make these safe loans for everyone. So now I've got the Renovation loan program rate card, kind of like the Renovate program that I had, or the rental property program I had before. And so on this one, note that there's also 4 programs. These are, again, 12-month loans. They have much higher interest rates, right? Well, our loan to values are substantially higher. And in most cases, we are lending against the after renovation value of the property. Right, so we have loans wherein the loan amount exceeds the actual acquisition or the purchase price for the borrower, right? But we certainly don't give the borrower the benefit of those programs or of that loan amount from day one, right? You have to put a little bit of money down to get started. There will be draws for the renovation, and you will have to do those in a reimbursement style wherein you put your own cash out to get through phase 1 of the renovation, and then you have to show photos and video and those types of things. So know that these are available, however, and these are very interesting, right? Keep in mind here that, again, there are some requirements in terms of cash, right? So don't expect that these are going to be able to cover 100% of your acquisition and 100% of your renovation, and the loan will cover everything all the time. You'll never have to have any cash to do that. And again, as I mentioned, on really short time frames, 10 days to close, and that's very beneficial in a situation where you need to close quickly. I mentioned the 10 days. The speed of this closing, again, largely based on you and your documentation that you provide, as well as escrow insurance and perhaps other third parties, but you will not be worrying about Marshall Reddick in terms of the time frame to get this closed. With our Renovate programs, there's not third-party loan servicing required. Certainly you as the borrower, if you prefer to hire a loan servicer and to pay for it, that's fine. But Marshall Reddick kind of functions as your loan servicer, even though we won't be collecting your payments and remitting them on to the lender. We would be your point of contact for customer service, right? And we're also the lender's point of contact for service, customer service, right? But the borrower in the short term in the Renovate loans makes the monthly payments to the lender directly, right? And the lender would let us know there's a problem, and the borrower would let us know. So we kind of function as that kind of quasi-loan servicer, even though we're not collecting and remitting payments. How to apply and how does the process work, right? It's really important. How do I get started? I'm interested. I'd like to know more. Well, first and foremost, you can call me anytime. I mean, I spend the majority of my day as the director of private lending with Marshall Reddick on the telephone. And that's educating new lenders. That's educating new borrowers like yourself, going over the rate cards, talking through scenarios, providing pre-approval letters. I mean, you name it, right? So we're very proactive in that capacity. And you want to really get to know your loan officer really well. I am your loan officer when it comes to the rental or renovate programs, right? So give me a call. But specifically how to apply, we've created a pretty cool loan application right on the borrower tab of our website. So you have on the screen here a section where you can see that and you can click there to apply for a loan. When that happens, you get dive into like a questionnaire, right? Now, don't be confused about conventional lending. Marshall Reddick doesn't do any conventional lending. When you click that, it directs you to one of our affiliates. That would be CMG and Reed Hazard, who does all Marshall Reddick conventional loans. But when you go ahead and click on private financing, it would push you through a questionnaire to kind of describe what you're doing to select the type of program that best suits you. And then you kind of dive right into that online loan application that I talked about, and it's going to continue to ask you questions as you go through this. So we're pretty proud of this. It works well. You should be able to get through this without questions, but certainly if you get hung up, you just give me a call anytime, and I'd be happy to go through it with you. Sometimes people prefer for me to do this over the telephone, and I love that as well, right? I kind of get to build a little bit of a relationship with you, kind of understand your situation, and I can maybe point you to the loan program that's best suited for that. And I have no problem taking all of this information for the loan application from you verbally. And then basically I would send this to you through the Marshall Reddick website for e-signature using Adobe Sign software. As far as the process goes, it's pretty simple, right? So you have the application we just went through. You have some documentation that you provide, including proof of funds for your down payment, your reserves, and so on. And then at that point in time, we'd be at the stage where we could provide you with a pre-approval letter. Right, extremely important for making your offers on the fly quickly and working with your real estate agent. Any real estate agent, as a buyer's agent that you're working with that knows what they're doing, is going to ask right away, are you buying with cash? Are you buying with a loan? Okay, you're buying with a loan. Who are you using? And are you qualified? Right, and this pre-approval letter is your key to getting started and getting into the game, right? So we can provide these to you very quickly, again, to let listing agents and also sellers know that you're a serious buyer and that you are approved for the type of loan that you'd like in order to be able to make that transaction happen. After that, you pre-approval, you can start making your offers as I described. And after you get your offer accepted, right, we're opening escrow, rock on. That's one of the best parts. You feel great. You've got your offer accepted. You're putting in your earnest money. You're ordering your inspection. We're getting title work ordered, and we'll be ordering the appraisal. Going back to our rental loans versus our renovate loans, I didn't mention on our rental loans, on our renovate loans, there is no appraisal. In a 10-day closing time frame, there just isn't time for that. And so one of the biggest roles of my underwriting team when it comes to the renovate loans is going to be the valuation of that property, right? And so they're going to be looking at comps. They're going to be looking at the scope of work, what's going to be done to that property. The more detail on that scope, the better. But they're going to be looking at the lot size, the lot location, is it a corner lot? What does the school district look like? All of these different metrics go into the underwriting and the formulating of an opinion of after repair value when it comes to the renovate loans. So important to know, again, rental loans, appraisal required. Renovate loans, no appraisal required. After we get through the appraisal and all of the other items, we're going to be on to loan documents, right? You get to obviously review those ahead of time. It's a very, very simple loan document package. I mean, you guys have gone through the conventional loan. You guys know that, I mean, literally the package is that thick, right? With ours, it's very simple, right? We have a security instrument, which is the mortgage or deed of trust. We've got a promissory note, and we've got a borrower closing agreement. So very simple and much easier to read. It's about this time what we'd be going and making and verifying your insurance is in place and working with your insurance agent to do that, so on and so forth as we take the next step, which is going to be obviously closing, funding of the loan, where you would be wiring in your down payment or your initial deposit, and the lender would be wiring in the loan amount into escrow. We kind of facilitate all of that. It's a very hands-on process. And then even after post-closing, right, you'd be working with my loan coordination team, and they would be boarding your loan with one of those loan servicers. Again, if that's a rental loan, whereas that won't be the case in the Renovate loans where there is no servicer required. Touching base again on loan servicing, this is simply a third party hired by the lender to handle all of the correspondence with the borrower. The borrower doesn't usually want to talk to the lender, and the lender doesn't really want to talk to the borrower, right? So in that capacity, it's very similar to a property manager for your loan, right? Those rental property owners that are on here who deal with tenants all the time, guess what? You don't want to deal with your tenants. Well, same thing from the lender's perspective. They don't really want to deal with the borrower. So they put that middleman in the middle to handle all of that correspondence. But that's really actually a good benefit for the borrower too. I mean, can you imagine a private lender on your loan and you've been making your monthly payments for, let's say, 4 or 5 years, and then you go to sell the property and you request a payoff, and the lender goes, "Oh my goodness, I didn't keep good accounting records. I have no idea what the payoff is," right? I mean, that would certainly be a problem. So the loan servicer is a very vital part of the process. And they do a lot of different things, right? Collect the monthly payments. They answer questions for borrower and lender. They do all the year-end paperwork, right? So the 1098 to the lender, the 1099 to the lender, and the 1098 to the borrower. Say that again. 1098 to the borrower and the 1099 to the lender. They do all the accounting, and of course, they provide all of those payoff statements as necessary when that time comes. All right, so this has been a super fun presentation. I'm going to get to some Q&A, and then we're going to wrap up for this evening. So some common questions I always get, right? Can I get a non-recourse loan as a non-retirement account individual or entity borrower? The answer to that is unfortunately no. Again, I mentioned earlier on that all of the programs are fine to be borrowed by individuals, LLCs, corporation, trust, etc. But we only afford non-recourse status when legally required to do so, which is going to be in the event the retirement account is the one buying the property or already owns the property in the event of refinance. Okay, so I'm fine making a loan to an LLC with no personal guarantee, right? So the individual that is the principal of that LLC or corporation doesn't have to personally guarantee the loan, but there would still in that situation be recourse against the LLC. All right, so the event of default, the lender forecloses and takes that property, and there happens to be a deficiency balance. Certainly, any other assets of that LLC could be grabbed by the lender. But again, that's only the default situation when there's a deficiency balance after any foreclosure. Where does all the money come from, right? That's an interesting concept, right? Where does Marshall Reddick get the money to make these loans? Well, kind of historically over the past decade or so, we have had all private investors, right? So Marshall Reddick clients who want to invest in real estate know that they have two options, right? They can buy rental property, right? We're happy to help them do that, but they can also become the bank and be the lender in the loans that we're talking about. But more recently than that, also proud to announce that we've launched the Marshall Reddick Mortgage Fund. So this is even a third investment option that Marshall Reddick clients have, right? So of course you can first buy the rental property. If you don't want to do that, you want something even a little bit more passive, right? Then you could do the direct lending, which is like trust deed investing or notes, if you want to call it that, right? That'd be like direct lending. And even more, if you want to get more passive than that, you could become a capital partner in our Marshall Reddick Mortgage Fund, right? So we're in the process of raising capital. This capital raise is going to be on an ongoing basis. And we're going to be making the exact same loans that are found right on our Marshall Reddick Mortgage Marketplace, which is where your loans as the borrower ultimately show up after approval, right? After they become approved and we know that we're moving forward with it, right? The fund will be making those loans. Those loans also will be funded by some direct lenders, and it's kind of in tandem based on what capital is available. So I just wanted to briefly mention, as I get that question all the time, I'm looking at my loan docs, and it's not Marshall Reddick that's on the loan docs. It's P Squared Holdings LLC, or it's the James Brown Solo 401k Trust, right? Know that Marshall Reddick's not always there. Marshall Reddick, as in my private lending team, we are certainly the loan broker in the transaction. We're facilitating everything. But we're not always the lender, right? So the lender could be any one of our thousands of capital partners, or it could be the Marshall Reddick Mortgage Fund. One of the last Q&A that I'm going to go over today, or the last question, and I'll provide the answer, is how does Marshall Reddick determine the rates and terms the loan programs offer? That's a very valid question. And the answer is we literally make them up. Right, the loan programs and rates and terms, we can change them at any time. They are not in any way tied to prime or any other market that's out there. They don't have anything to do with the stock market going up and down. They don't have anything to do with the Fed lowering rates. And in fact, I think that our loan programs are very competitive in the private space, especially in the renovate space. And we need to do that because we need to attract the best of the best borrowers, the most sophisticated borrowers, those folks with good FICO scores and plenty of cash, but just have one of those reasons. Again, they're using a retirement account, right? And they want to leverage their retirement account using rental real estate. So we make them up. Again, we reserve the right to change them at any time, but certainly as a borrower, if you enter into a fixed rate loan, it can't change. It's fixed for the term. Okay, and we don't offer any variable rate programs. We offer a couple of balloon programs like you saw, but there are no variable rate programs. So you don't have to worry about that interest rate going up or down after origination. So don't forget, book your complimentary consultation. Again, Tanya is just one of my favorites, such a wealth of information when it comes to real estate advisors that work in the Newport Beach office with me. I have been kind of the senior team member at Marshall Reddick. I'm going to be celebrating my 17th anniversary, 17 years. Wow, it sounds crazy to say that, this June. But Tanya is kind of one of the old guard as well, where she's been with us for many, many, many years, been through, hundreds and hundreds and hundreds of transactions, all type, whether it's rental, renovate, you name it, right? She knows all of the players in the game. And so it's extremely important that you build those relationships with the folks at Marshall Reddick. And that includes your real estate advisor, your real estate agent that's in Texas or in Tennessee, as well as your lending team, your underwriter, your loan processor, and of course your loan officer, who's me, Patrick Prunty. Tanya, again, will be following up with each of you post this presentation, and kind of going over goals and answering any questions. And again, certainly take advantage. Marshall Reddick's one of their biggest benefits that we offer is the free education, right? And you just can't get that. There's no books and tapes for sale here. We want you to invest with us because we believe in everything that we do. So thank you so much for being with me tonight. Again, here from sunny Southern California. And I wish everyone the best of luck. And keep in mind, guys, right now we need to be prepared. There's going to be so many exquisite, super amazing buying opportunities. I think back to myself when I was prepared. I bought a property in Phoenix in 2012, and I literally paid $65,000 for that property. And today it's worth in excess of $250,000. I'm not sure that opportunities at that level are going to be available, but make sure that you're ready and prepared for them. And then make sure that you understand how the private financing at Marshall Reddick works, especially for those retirement account borrowers who need those non-recourse loans. So thanks again. My cell phone is available to you at any time. Email is also fine. So appreciate you guys so much, and be safe, be well, and be happy.